Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently 5:30 p.m. Eastern, Monday, May 15th. Now, we're going to be doing something a little bit different today and giving some extra information and value as we will be doing some higher time frame analysis as well as looking at key price points on major asset classes across the board, which is going to tell us significant information of order flow as well as give us a lot of usable information as manual retail traders on how we should be executing trades over the next days and weeks to come. To jump right into it, we're going to be reviewing gold here on the higher time frame. I posted about this on Twitter, Instagram, as well as Telegram last week and sent just some text messages as well as charts about key price points across the board. Now, don't get me wrong. Understanding the overall global macro environment, how recession scares are worsening, how we have a lot more global fear, uncertainty, and doubt. We still have a high interest rate environment coupled with high macro inflation and, of course, economic activity dampening across the board. The overall base case for gold buys is starting to increase on the higher time frame. But we have to be very careful as we are not investors or positional traders. The majority of us are scalpers, day traders, some even swing traders holding positions for a period of days or weeks, right? Understanding that, we have to be very careful when we look at key price points of interest, and especially when you're trading a beast such as gold, where it can have very large corrective waves and changes in price formation. Even during the dollar domination phase here in 2022, after you can see we peaked these highs in the 2050s with Russia's invasion of Ukraine, of course bringing new fear, uncertainty, and doubt to the market, potential escalations of World War III, it's very interesting how we still came to these same historical high price points printed from the COVID crisis and still failed to break. Now you can see during the dollar domination phase when the Fed started their most aggressive rate hike cycle in history, which obviously decreases the demand in gold and other asset classes at that time and increases the demand in the US dollar as the Feds are doing front loading of rate hikes in a very short period of time. Gold had this aggressive downside move from the 2000s all the way to the 1600s. But that's not important. Majority of us are not holding one position for the entirety of a year. We're trading the markets during the business days, we're scalping sessions, we're looking to day trade and swing trade. When you see gold in this overall bearish structure, you can see these corrective phases of price where you can have pullbacks in short-term bullish plays that can be hundreds and hundreds of pips in movement and can last a period of days or weeks. Here you can see gold extend bearish from 2000s to the 1910s, then have a pullback over a period of a month all the way into the 1980s, 700 pips before continuing the bearish trend. So understanding gold movement, these massive swings in price on the higher time frame are very common, and from our perspective of manual retail traders who are day trading and scalping, we have to be able to assess and analyze when these market phases are taking place so we're not on the wrong side of the market. For example, if you're a day trader or a scalper who's selling gold, during this pullback phase that's lasting a potential 2-week period where gold is going from 1920s to 1980s, you obviously do not want to be selling at that time. You want to be sitting at your hands or playing some of the buys in the short term until the better sell setup, still respecting structure, right? Now, if we bring that same ideology to the market structure we are seeing now, we can see something more on the inverse side, that we're creating stronger bullish market structure. But even with some banking sector failures that we saw in North America, we saw in Europe, we're starting to see in Asia, even with recession scares starting to deepen, with economic data on the decline and still having this environment of higher interest rates coupled with high inflation, gold has still failed to break a very significant price point at the 2040s. Now, I'm not saying gold's going to go all the way bearish back down to the 1600s. I'm saying if we don't have any fundamental catalysts to be breaking above here, from a technical perspective, if we cannot break above the 2040s, then seeing a potential corrective wave on gold here is very, very common to see. We can easily see gold come from the 2020s into the 1960s and 1950s, retesting these previous significant highs, as well as subjective trend line here, just highlighting some bullish market structure, right? If we do not get any new global fear, uncertainty, or doubt, or continued stacking bad global economic data, or we do not see a significant outflow out of the stock markets and the risk hedging occur, where we see the outflow out of the stock market and the inflow into a safe haven such as gold, then in the short-term period, it would not be out of the ordinary for gold to see this potential corrective phase, seeing a pullback phase and potentially retesting better buyer demand zones before we see buyers starting to come back into the scene there, right? So what you have to understand is, one, learning to identify these potential waves in price, two, adapting to these waves in price, and three, adjusting your psychology and execution accordingly. Now, what we can see when we're zooming in here is we know that 2050s is a very significant price point, both from a technical and fundamental standing. What we can see is even when we had major fundamental catalysts in play, historical events such as the global lockdowns, the central banks dropping rates to zero, and obviously increasing money supply and pumping the markets, we still did not have enough reasoning or buyer volume to be extending above the 2050s here during the 2020 period. Even when we had Russia invading Ukraine for the second time in the course of the last decade, and that brought new fear, uncertainty, and doubt with military escalations, uncertainty to commodity supplies and demand and supply on that side, and of course we saw more demand pooled into gold as a safe haven, we still failed to break that 2050s area and had a pretty aggressive pullback phase, right? And even though we had some banking sector failures with the SVB collapse, the Credit Suisse issue within the European banking sector, we've had recession scares deepen as well, we still have not been able to break above that 2050 standpoint. So you have to ask yourself, there's a potential high probability of seeing a corrective phase or larger bearish legs down on gold if we don't have the fundamental reasons in the next short-term period to be breaking above there. Fundamental reasons of new global fear, uncertainty, and doubt would be larger banking sector fallouts of new institutions we haven't seen collapse already, potential actual further military escalations with potentially China, of course, invading Taiwan, or any World War III escalations that obviously is not good for us from a humanity standpoint, but it would bring new fear, uncertainty, and doubt, outflow into the stock markets, and inflow into gold, right? Now, the same time gold is rejecting that key higher time frame price point, when you zoom in here, you can see the exhaustion at these highs, as we're seeing around the 2040s here, not enough buy side liquidity to be trading higher, and understanding that that 2050s to 2060s area is a very key important price sensitivity area. So a key pullback zone that I'm looking to at least retest would be going into the 1940s. And when we're looking at gold here, if we cannot be breaking back above those highs, and if we start to break back below the 2000s, seeing a bearish corrective phase on gold that can potentially last a couple of days or weeks and be hundreds of pips in size would not be out of the ordinary at all. For the example here, you can see gold had a beautiful bullish rally from the 1600s all the way into the 1940s, But as you did not have any fundamental catalyst to break higher at that time, you can't ignore this corrective phase where you had this 50% correction and pullback going from the 1940s to the 1800s. That's more than 1,400 pips. And you have to understand that corrective phase lasted almost a month there, going from towards the end of January into March area almost, right? So we may see this potential corrective phase on gold if we don't get any new fear, uncertainty, and doubt over the next days and weeks, starting to come into the 1940s and 1950s as your first area of interest if we don't have any fundamental reasoning to break above the 2040s and 60s. Now, what this also does is give us very clean-cut information where we would also just see further safer buys if we do break these historical highs. If we do have any new fear, uncertainty, and doubt come into the scene, a continued collection of bad economic data, and we're trading above the 2050s and 60s, that's very smooth sailing buys. But other than that, it's very difficult for me to have some conviction in those buys. I see a higher probability of a corrective phase as stated before starting to see buyers come back into the scene. Now, what's very interesting is the same time we're seeing that exhaustion here on gold at these very key higher time frame price points, when you look at other major asset classes, like you come in here and you look at the US dollar currency, we're also retesting very key demand zones on the flip side. We've been very, very attentive and focused on this historical price sensitivity area from the pandemic and even during the dollar domination phase, which is better to highlight here in green, where we've seen order flow accumulation around 101 to 102. You've seen either very strong rejections here on the sell side, which here was obviously when the pandemic first came into the scene. You just had an initial spike up in fear as the US dollar is a safe haven currency and your global reserve currency. But as soon as the cartel of the currency, the Federal Reserve, jumped in and exponentially increased money supply and started pumping the markets, dollar reversed from that point. But you can also see that when the Federal Reserve started their most aggressive rate hike cycle in history, that from this same price sensitivity area, we had a break and retest and pullback and still had bullish buyer order flow accumulated here before continuing higher. So this 102 price point is a very important price point on the dollar, which is also still maintaining potential bullish bias here when you're looking at dollar. It's very difficult for me to have conviction in dollar bears or of course gold buys on the higher time frame if the US dollar is still holding above this key price point at around 101 to 102 and gold is still holding below the 2050s. Now, when you bring this information together and look at some of your currency pairs, you're going to see this correlation across the board, but how you're retesting very key higher time frame price points across the board. And the reason why the higher time frame is so important is we understand real world events and algorithmic institutional order flow dictates how the markets move. So when you see very strong reactions on the higher time frame and significant changes in price from a very significant point you've identified, it gives you a lot of important information. And we're seeing that here with gold at the 2050s. We're seeing that there with the dollar at the 101 to 102 area. And when you're coming to look at the dollar pairs, you can see in the example of USDCAD, I sent these buys out ahead of time where we're holding a very key demand zone here at around 1.32, 1.33 on USDCAD. And when you understand how USDCAD behaves, where you have the dollar as the primary in the quote and the Canadian dollar as the secondary, which the Canadian dollar also has a lot of influence related to commodities and crude oil, as Canada's main revenue source is exporting crude oil. You have these very drastic price changes on the intraday and higher time frame, where you may not break significant highs right away, and you have these large corrective waves in price. But on the flip side, if you're still maintaining that overall bullish market structure and respecting some of these key demand zones, which in the example here you could see was around 1.24, here you can see the same thing with some of these corrective waves, but still maintaining bullish market structure above this very key demand zone at 1.33. The same time, dollar as our world reserve currency is still holding above that very key price point at 101 to 102. So if dollar's still holding above that 101 to 102 area, if USD CAD can't break below here, the potential to be heading back into these highs at 1.38 still looks very evident when you understand this overall macro trend and movement. And it's not just USD CAD, which is at very key price points on the higher time frame. It's not just gold or US dollar individually. Even when you come out and look at some of your other dollar pairs, such as GBPUSD or EURUSD, where dollar is the secondary in the quote, you can also see we're retesting very key price points. Overall dollar domination move, and when Russia invaded Ukraine led to this aggressive bearish run, GBPUSD almost going to the parity point. This has been a rough 50% correction of that overall bearish move on the macro, and we've been retesting this very key liquidity zone as well as bearish structure here around 1.26, 1.265. Now, if we see dollar continuing to hold above 102, the Bank of England just had the priced in expected rate hike and didn't bring anything new to the table. Seeing some buyers take profits here and sellers entering from these better price points on the higher time frame and seeing legs down to 1.22 would not be out of the ordinary at all. So you're seeing the correlations across the board. Gold starting to show exhaustion at very key price points where we can see correction and potential legs down. GBPUSD as highlighted there. USD CAD, obviously more of the inverse as dollar is the primary in this. Dollar itself holding this very key price sensitivity area. And EURUSD being very similar to GBPUSD, where we're retesting very key sell side liquidity zones. Right? So seeing these potential legs down with dollar strength starting to come back into the table, especially if we still have continued just mixed or more optimistic data. Feds are sticking to their same path. Dollar holding above those key price points. We can see those types of movements we've been talking about on the higher time frame. Even US 30 here is at the same price point it's been since May 2020, May 2021, May 2021, May 2022, and now May 2023. You can see here is May 21. You can see here is May 22. And right now, May 23, still holding below a potential very key liquidity zone, roughly at 34K, which held significance both during the buyer rally and as sellers have started to come into play, where if we see continued demand in the US dollar, we have continued economic data taking away the hopes of rate cuts in the near future. Feds are continuing to keep financial conditions tight, seeing a corrective wave on equities and bearish leg down in the example of US 30 to 32,400, 32K flat is not out of the ordinary at all, understanding overall order flow, key price points of interest, and higher time frame analysis. GJ as well, beautiful buys that we called live from 168. We even called Bank of England, literally just leading to a liquidity grab, data-induced pullback. GJ is also still respecting bullish market structure as the Bank of Japan remains dovish. Bank of England, even though they're more neutral and didn't bring anything new to the table, still need to keep financial conditions tight. If we don't break this intraday bullish market structure forming, GJ has a lot of potential to start printing some new higher time frame highs. Still running that historical repetition, which I've talked about in Capital Hungry webinars for free on this channel, a very similar movement after the post-2008 GFC crisis. Where we also have resolutions with Brexit, so we could easily be coming back to points GJ was at prior to the Brexit collapse, which is starting to have these pullbacks and trending into the 170s, higher into the 170s and 80s. Right? But anyways, just a quick little higher time frame review. Overall now, when you're looking at market analysis and trade ideas for the coming sessions, we just want to look at market sentiment and understand that global equities are still relatively mixed, but starting to show signs of exhaustion. Dollar is holding more bullish on the intraday as we finally had a break out of this 30-day range, still holding that very key higher time frame price point at 101, starting to form some stronger intraday bullish structure, breaking above that 30-day range at 102, where even if we get pullbacks to this area or start to break above 102.5, I still want to start to play some of these dollar bullish bias, looking for some of those reversals on EURUSD, GBPUSD, those demand zone buys on USDCAD, and still seeing some potential outflow on equities and corrective phase on gold, as we reviewed on the higher time frame. In terms of Japanese yen is still individually bearish on a dovish Bank of Japan sentiment, still keeping their monetary policy loose, continuing to pump their markets and economy. And I still want to play that bullish bias on GJ. I would prefer to see volatility index trading above the range in 18 handle, just to show some more short selling in the US equities and potential outflow there. But we've just been ranging here on the volatility index. I do still have low expectations with volume and volatility. A quick little fundamental reminder here for those of you who have not noticed over the last few months, but the market movement has been primarily dictated based on data. The central banks have set the stage where everything is pretty much data dependent. If you don't get any new reactive events from headlines like banking sector fails or military escalations or any new political disputes that hold market weight, then the markets have literally been going from important data report to important data report with your focus on like jobs data, inflation figures, PMI, consumer activity, and so forth. And in between then, markets are relatively quiet and ranging. So I do expect the markets to still be relatively quiet, seeing some secondary phases of market structure where we can see gold primarily just ranging, GJ probably just starting to slow down in some of its price action here, dollar pairs probably seeing some short-term pullbacks or corrective phases. But other than that, we still want to stick to our same trade ideas and bias. But before we jump into the individual analysis across these trading pairs, we just want to understand what economic events we have on the table in focus over the next coming sessions. So we're going to do that first right now. So today, keep in mind if you're trading Asian session or looking for any setups during Asian session, after China market open hours at 10 p.m. Eastern, we do have some important economic data from China, with expecting some very optimistic rebounding in data in urban investment, industrial sector, and retail sales. Retail sales expected to almost double from the prior. So that might bring a little bit of optimism into the Asian session in terms of risk flows, but just keep that in mind. That's the only data through Asian. Through Europe and through the European and London session, we also got some important economic data. Now at 2 a.m. Eastern, we have all of our labor market data for the UK, which is like the equivalent of when traders during New York are waiting for NFP, except this is your job change, unemployment rate, and wages data for the UK. So that's at 2 a.m. Eastern. I'm still expecting this data to be relatively solid. If it's poor, it's just going to lead to continued GU downside and a bearish pullback on GJ before buyers come back into the scene. But I'm expecting the data could still be more to the neutral, optimistic side, still extending GJ upside and potentially leading to a GU pullback before the bears come into play. Then we also have some inflation figures for Italy here impacting euro pairs at 4 a.m. Eastern. Inflation data is pretty much priced in, still expected to be higher on a macro perspective on euro, especially as the ECB was behind the curve and a bit late to their rate hike cycle compared to the Federal Reserve. And they were also coming out of negative integer territory, like coming from negative rates back into positive, where feds were going from 0 up. Then we have some GDP figures for Eurozone at 5 a.m. Eastern, which is also Asian session close and the larger 4-hour candle closures for most brokers. So keep that in mind. And then during our North American trading session, if these numbers are actually as optimistic as expected or better, this can also lead to dollar strength and potential correction on gold and bears coming into play with some optimistic retail sales. Otherwise, if this data is bad, that's going to lead to dollar weakness and gold bulls. Canadian inflation figures aren't going to really hold that much impact. And then also for US economic data, which is also important and can potentially lead to dollar ranging, is we could get optimistic retail sales, but on our industrial side reporting still have poor data. What would be ideal to see dollar strength and gold correction in bears would be healthy retail sales and better than expected industrial production data into that new 4-hour candle. Keep in mind, we also have a lot of Federal Reserve and ECB speakers scattered throughout the session tomorrow. So you have to be looking out on your live headlines, as they will be talking about inflation, economies, monetary policy, and so forth. Majority of their comments and statements are well known, copy and paste, nothing really new being brought to the table, but always something you have to look out for just in case something new is being brought to the table that the market's going to digest, adjust, and price in accordingly. Okay, so now when we're looking at gold, overall we're just in a consolidation zone, but I'm still relatively bearish if we're remaining below 2028s here and those key higher time frame price points. If we get these pullback phases, I'm still going to be looking for these intraday sell plays, and especially if we can break the lows printed from the previous weeks from NFP around 2004. This is my main bias of primarily looking for these sells on gold, the pullback or the continuation sells. I would only be jumping into gold buys from current price points if we're breaking well above these price points from the CPI and producer price index rejection. We have any new fear, uncertainty, and doubt or bad economic data and breaks above 2035s. On GBPUSD, on the intraday here, we're starting to show more signs of exhaustion by buyers from those key liquidity zones. The same time, dollar still rejecting 102 and showing us dollar buyers starting to come back into the scene. Understanding US dollar as your world reserve currency is going to hold more weight in whatever pair it's in. Give or take some minor pullbacks you can get into the new daily candle, I would still be looking for these main sell plays on GBPUSD, just seeing this as a potential pullback for this new week. Only adapting to GU buys above 1.258. And even with these adapted buys at 1.258, our secondary bias, if our main bias is incorrect, we still have to be very cautious of GU digging into those higher time frame sell side liquidity zones at 1.264 to 265. EURUSD is very similar to GBPUSD, but showing us much stronger bearish market structure formation, where from those sells we called in the EURUSD webinar, make sure you check out the GU, EURUSD, Gold, GJ webinar on the channel for free. There's tons of them, so you can track and see what's been going on over the months and weeks. But those sells we were calling from these highs and the potential reversal points, if dollar still held 101 to 102 area, have been playing out great. And you can see stronger bearish market structure in a few ways. One, obviously sellers printing these lower lows, which is fantastic. Two, the difference in price anatomy between the impulsive moves with trend and the corrective pullback phases. And three, none of the pullback phases breaking overall bearish market structure or back below previous significant price sensitivity areas. So it's still early into the new week, and it's very common as we've been having these significant lows printed to get these pullback phases. If we hold above the key level 1.087, you could easily take advantage of that pullback phase to come retest these better sell zones before still continuing the downside sells. Still playing this descending channel formation, bearish structure, short-term adapted pullback phase to better sell price sensitivity areas at key level, retest of structure and liquidity 1.092. USDCAD, I'm still a bullish bias above 1.323, 1.325. Getting some pullbacks is completely normal here. Even if we come to retest 1.34 just for the new weekly setup, I'd still be looking for USDCAD buys above these price points. It's very difficult for me to see any USDCAD sells unless we have completely garbage US economic data and breaks below 1.33. We would need very high CAD CPI, very bad US data, dollar below 102, USD CAD breaking weekly level. Now, US 30, it's been a struggle as we've been looking for those intraday and big shorts from 34K. It's been playing out very well. I highly advise to watch the US 30 webinar that was done as well and broken down on YouTube here for free. Tons of content on this channel, over 400 plus webinars, all analysis, live trade calls, scalping sessions, intraday trade ideas, psychology webinars, webinars on risk management, market sentiment, volatility, you name it, it's here on Capital Hungry and for free, right? But anyways, understanding market psychology, it's still been a struggle. We have to identify these key price points of interest. We do need to be breaking below this 32,800 handle to see any downside moves to 32K. Overall, equities are more just ranging on the intraday time frame. I am still bearish below these points at 33.5, 33.3, and 33K. I would like to see VIX trading above 18 to further support this bias from an intermarket correlation and sentiment perspective. Any new fear, uncertainty, and doubt would support that as well, or just continuing to see more demand in the US dollar and the market starting to fade out some of those future rate cut hopes and buyers liquidating positions from these highs. I can only be jumping back into stock market buys after a correction and more aggressive downside pullback phase, or breaking above 33,800. Last but not least is GJ. We just want to keep in mind GJ at these very key high price points, but overall still looking to play a dovish Bank of Japan. Bank of England still needs to keep rates up, bringing more demand into GBP. Even if we get pullback phases that can be data induced to this liquidity zone from Bank of England prices here and around 169.8, where we had this pullback phase before extending back to these intraday highs, would be great setups for the new daily candle period, or just continuing further bullish. Higher time frame is still bullish. Still got individual yen weakness on a dovish Bank of Japan. USDCAD is not going to be changing that policy anytime soon. There hasn't really been any new fear, uncertainty, and doubt to bring short-term demand or appeal to yen's safe haven side. And still holding some key bullish price action. All right, everybody. So I'm going to save and upload this. You can always rewatch it as you wish. Make sure to share it with your friends, other traders, trading communities. Most paid mentors don't even do this for you in their cookie cutter courses, but Capital Hungry is always here to help you out. This trade history, I sent the trades I take in the history in Telegram, Twitter. You can all see it there. I actually took these 168 buys. You can see even the live call from Bank of England to this area too. But yeah, make sure you like, subscribe, comment, enjoy, take care, have a great day, have a great week. I'll probably be on Raja streams as he's going back to more of a routine schedule. I'll probably be on his streams in the morning as well for anybody who watches Raja Bank streams.